you're thinking of investing in a private credit fund, you're going to be invested in that fund for a period of time, a number of years, close to 10 years in certain instances if it's a closed-end fund from start to finish. So volatility is inevitable. The risk of a recession is probably something you can't avoid, although especially in the US, there hasn't really been a very serious recession in quite some time. You have to be prepared for that. So I'm going to go back to that same word that I've been using throughout this discussion, conservatism. I think part of our philosophy for sure is if we can construct more conservative investment portfolios, we should be very well positioned to survive any volatility, to survive what happens during some kind of economic slowdown or a recession. So when we think about conservatism, there's a couple things that we think about. Debt to EBITDA ratios of the companies in which we're investing. We're not chasing over-levered situations, high levered type investment opportunities, because we want to stay a little bit more on the conservative side of the spectrum. Loan-to-value ratios are very much a similar construct for us. When we're lending money to a company, especially one owned by a private equity sponsor, we want to know that the sponsor that owns that business has significant skin in the game. So a low or a modest loan-to-value ratio to us means that we have a partner in the owner of the company who's going to be there to support it to the extent something happens or there's an economic slowdown. And beyond that, we're very, very focused on businesses that have long-term track records, that have been through cycles themselves, that have a history of generating long-term free cash flow. Investors that have come into due diligence on our platform and have examined our track record find one very consistent theme, and that is that the fixed charge coverage or the debt service coverage ratios of the companies in which we're investing demonstrate resiliency. And that cushion is there in the event of an exogenous shock, in the event of an economic slowdown, to ensure us, and so we can ensure our investors, that in the event something bad happens, there should be some extra cash cushion to continue to pay us the interest and pay us our amortization that's due every year. Because what we found and what we know is EBITDA doesn't pay us interest and loan amortization every year. It's free cash flow. So that's what we're very focused on.